Welcome into the Finance Report. I'm David Wogenson. In just a moment, I'll be joined by my co-host Mallory Hoff and financial professional John Blanchard. On today's episode, we'll talk about living the dream in retirement and why so many retirees are fearful they may be unable to. A lot of that stems from what's going on. Economic uncertainty, market volatility, and inflation. We'll talk about those big risks and how to overcome them. And then in 15 and 15, taxes and why the set it and forget it mentality might not be the right strategy for you. But first, joining us now is Acadiana's retirement strategist, John Blanchard. John is a financial professional with Matthew James Tax and Wealth Management, and he's also a popular radio show host.
You're watching the Finance Report, and as David just outlined, we have a lot to cover today. The retirement landscape has shifted, and a lot of pre-retirees are trying to figure out if they've saved enough. Look, we all have kids here, and I think one thing we're hearing a lot of right now is I thought I was going to be able to leave a certain amount for my kids, but the reality is I have to cover my monthly expenses in retirement, and I just don't know what's going to be left over.
So John, let's start here. For those in or nearing retirement, what do they need to know as they try to work through these things?
Yeah, look, I mean, with the inflation that we've been seeing these last several years, it's been tough for a lot of people that are either in retirement or about to go into retirement. We're even seeing some parents helping out their kids with their finances because they're worried about their grandchildren as well. So we have to look at, number one, where is your money invested? What's the risk of those investments? And then also looking at what's the tax liability on these investments. So we want to make sure these assets are going to be there for the long haul. We have to make sure that you have some security in the way it's structured.
So John, with all of those things in mind, what questions are you getting often in your office right now?
Well, I mean, a lot of people are just looking at what they have. Will I have enough for retirement?
Yeah.
Can I draw enough off of this? Am I taking too much risk? Or how much can I withdraw? What's the most I can take out, per month or on an annual basis without running out of money?
For the pre-retiree, when should they really start sitting down and putting together a plan?
Yeah, I mean, look, ideally, the sooner the better.
Okay.
But realistically, the earlier on, if you're 55, great. If you're 60, great. At any age, it's just get started looking at it now. If you're 5 years, 10 years away, that's a great thing because ideally, we got to look at the projects that you have in retirement. You might want to update your kitchen. You might have a new vehicle to buy. We have to look at the travel expense that you're going to have.
Sure.
We have to earmark all these dollars that need to be spent and organize them to where every dollar has its own purpose in retirement.
John, I have heard you talk time and time again about the importance of tax strategies when it comes to a big picture retirement plan. How important is implementing the appropriate tax strategy when you're preparing for a 20, 30, even 40-year-long retirement?
Yeah, see, what most people didn't realize was the amount of tax liability that they were going to have in retirement, because most people often heard when you go into retirement, your income's lower, so therefore your tax bill is going to be lower. That's actually not true. We see more people have a higher effective tax rate than when they were working. So that's pretty alarming.
Yeah.
So the key thing is we have to look at creating a distribution strategy to where they can have a lower tax liability whenever they're taking their income. The other thing we got to look at is what type of legislative risk are they exposed to? Mm-hmm. So as the DC changes the bills, it changes the tax law, we got to look at how will that affect you. So ideally shifting assets to either Roth or Roth type of investment accounts, so where you can have money growing for you, but also taking income off of those accounts without paying any taxes. That's a key thing because the amount of debt our country has is crumbling the value of your IRA, your 401k, because it has such a high tax liability.
Why do you think so many retirees are caught off guard about these tax traps awaiting them?
Yeah, I mean, look, we have people that come in all the time that are not even aware of it. Some of them found out 6 months ago, 2 months ago, a year ago, when they've had years to look at it, but nobody's ever talked to them about it. Out of sight, out of mind, realistically. So we just have to look at the vulnerability that they have, what their exposure to is to higher taxation, and then from there help course correct. Use tax strategies to offset, moving money over from tax deferred accounts to tax-free accounts.
John, I want to take a moment now to talk about the do-it-yourselfer. I think there are a lot of folks who are pretty good with a spreadsheet.
Sure.
Okay, a lot of resources obviously available online now. A lot of people think, I can do this. I can plan my own retirement. In your mind, from your experiences and what you're seeing now, what's wrong with that?
Yeah, so the thing is, we see a lot of people come in and they are do-it-yourselfers. They have done very, very well, very, very successful at building a large nest egg. But the big thing that we see them overlook is the actual tax strategy. They looked at, okay, what kind of returns can we generate? And they're using IRAs and 401k accounts, tax-deferred accounts. But what they did was create a much larger tax liability that they ever thought they would be exposed to. And then the other thing is estate planning. Because we got to look at taking distributions from this account while, let's say, you and your spouse are alive. And down the road, unfortunately, we see people, they have to file as a single filer because of a loss of a loved one. Then you get a very large tax liability with that called the widow tax. And then whenever those assets change hands to the next generation, that's where you're going to see the most taxes getting paid on these dollars. These are things that we need to address to lower the liability, not just today, but forever.
John, excellent insight and guidance as always. Thank you. And with all of that in mind, the time to act is now.
It sure is. Today, exclusively for our Finance Report viewers, John has a great offer. Right now, for the first 5 callers with a portfolio of $250,000 or greater, he's offering a no-charge, no-obligation, full-blown retirement income plan just for you. This will allow John's team to sit down with you personally and provide you with a roadmap going forward. Again, all of this at no cost. The number to call right now, it's 337-366-8366. Once again, that number, 337-366-8366.
Your 401k, your IRA, your TSP. For a lot of people in this country, the hope is that these accounts will sustain them in retirement. But will they? So, John, what do we need to be aware of in terms of our retirement accounts?
Yeah, so, we got to look at 3 major things. Sequence of returns risk.
Sure.
The amount of money that you're pulling out and on, with positive but also negative markets. How will that facilitate how long your accounts will live in the event we have market fluctuations? The other thing we have to look at, taxes.
Yeah.
So that's a big thing. That's a big expense. But the other big expense we have to deal with is healthcare expenses. So we have to look at things holistically. Where we're placing the dollar to be invested, what kind of risk we're taking with these investments. The other thing is we got to look at the tax liability on all of your different types of dollars, because not every dollar is taxed the same. And then we have to look at healthcare expenses.
John, I think a lot of people are contributing to their retirement accounts and they feel like they're doing the right thing, and yet they're not planning in advance when it comes to what do I do with these accounts? When is the appropriate time to start planning?
Yeah, so look, ideally, earlier the better.
Yeah.
If you can do this maybe in your mid-50s or even at 50 or
Okay.
45, that'd be great.
Earlier than some people think, yeah.
Earlier the better. But the thing is, we got to look at what is the goal age for you to retire. Is it 55? Is it 60?
Yeah.
Is it 62? Is it 65? Is it 67? So that will determine where you need to pull your money from, but that also means that's going to determine where you invest your money. We got to look at access. We got to look at how taxes work on these dollars whenever you receive it. We have to also look at how will it potentially make your health insurance cost increase in retirement as well. We have to look at all these things, but we have to look at it holistically, how one thing can trigger another from a tax standpoint.
Are people surprised to hear this at times?
Yeah, look, a lot of people are pretty intrigued at the fact that you have to look at all these different areas whenever you're planning out your retirement. If your goal is to retire at age 55, you need to take different actions on where you invest your money, where that money's placed. You have to take a different set of actions whenever you're trying to retire after 65. But we have to look at all these different age ranges because there's different milestones of retirement that you have to reach, and you need to place money in certain areas so where you can pull it out without added penalties, added taxes, added healthcare expenses in retirement.
All right, so what do you say then to the person or the couple that's procrastinating on this?
Look, the more you procrastinate, realistically, the more it's going to cost you in taxes and health insurance cost in retirement.
John, if you have one message to folks who, again, think they're doing all the right things, what do they need to know?
Yeah, I think what they really need to see is the big picture on how taxes will affect your retirement, not just while you're retired, but whenever you pass that money along to the next generation. Just your surviving spouse, number one, but then when it goes to the next generation, the tax cost associated with it. But I think also people need to understand the risk they're taking with their investments. Some people look at what their return is and thinking, okay, well, my account is maybe conservative, but how much risk are you taking to get that specific return? These are things that people should know about, and also look at the fee structures. A lot of people are very unaware of the fees that they're charged on their investments. So it'd be a good thing to get an inventory of your fees, and so you can make better decisions on where your money's placed.
John, always a pleasure. Thank you for joining us. We certainly do appreciate it. Coming up on the Finance Report, planning for the future, but living in the present, setting money aside for the different stages of your retirement. And up next, David will put John on the clock. But first, exclusively for our Finance Report viewers, John has a great offer. Right now, for the first 5 callers with a portfolio of $250,000 or more, he's offering a no-charge, no-obligation, full-blown retirement income plan just for you. This will allow John's team to sit down with you personally and provide you with a roadmap going forward. Again, all of this at no cost. The number to call right now, 337-366-8366. Once again, that number, 337-366-8366.
Time now for 15 in 15, 15 topics in 15 seconds for John Blanchard. And of course, you know the drill, so here we go. Question number 1. John, we want to enjoy our retirement years, but not like this, because it was discovered that the average retiree household spent 111%, I'll say it again, 111% of its after-tax income. What's the best way to get back on track?
Yeah, look, I mean, this is a big problem. With the amount of inflation, we see the amount of credit card debt nationally on the rise. And so we have to look at where our spending is happening, how much we're spending, where we're pulling the money from, and also how much risk we're associating with these dollars.
Yeah, 111.
It's a lot.
Decrease that. Question number 2, taxes can be one of, if not your largest expense during retirement. So my question to you, can you make your retirement tax-friendly?
Yeah, you can. You can make it tax-friendly. You can actually make it tax-free.
Sign
and
me
it's
up.
with special planning. So we offer a lot of tax strategies to help people move their money from their IRA to their Roth without even paying taxes.
Okay, I think tax-free. Sign me up, line out the door for that type of situation. I think retirees are on board. Question number 3, if healthcare can potentially be an even larger expense during retirement than those taxes, why are so many people unwilling to engage in that conversation?
Look, there's a lot of things that are unknown about taxes, but also healthcare. So we have to point it out and look at what are the provisions, look at the income thresholds that increase your healthcare costs in retirement, and what can you do by special distribution planning to lower your healthcare expense in retirement.
Let me go sidebar. If you're not planning for taxes and healthcare, what could you potentially be costing yourself?
Oh, it's a tremendous amount of money. You could be spending half your money just in healthcare and taxes in retirement.
Half of your money, not what you've worked decades to see happen. Question number 4, set it and forget it. If someone is basically clueless or uninformed about their investments, their savings, is that always a bad thing?
Look, we have to look at it to keep things simple. You know, people want a simple turnkey retirement, but there's so much complexities whenever you're going into retirement. Healthcare, taxes, estate planning. We have to look at insurance costs. We have to look at all these different things to make sure that we can make it simple. But when I talk about simple, I'm talking about lowering your volatility to keep things simple.
Absolutely, want to avoid those big losses. John, I recently read an article where the advisor being interviewed was saying to stay the course so you can take advantage. Why is this an insincere message for those in or nearing retirement?
Look, ideally, we have to understand the amount of risk someone is exposed to, but look at what other strategies are on the table for your IRAs and your Roth accounts, using tactical investment strategies to make a decision when it's appropriate to be in the market. Then these investments, these models can make a decision when it's appropriate to sell and when it's appropriate to buy back. So it's using technology, using data to make better decisions instead of riding the roller coaster of the stock market.
And some advisors may just want you to stay in the market because they get paid.
Yes, absolutely.
My words, not yours. Question number 6, services, they do cost money, but when it comes to working with a financial advisor, what should people really expect to be paying?
Look, ideally, you have to be getting a tremendous amount of value whenever you're paying for an advisor. We got to look at things from a tax standpoint, having a tax foundation on the way you view things, especially holistically. So you have to look at, number one, where you're placing your money to be invested in the future, not just for the return, but for tax efficiency. The other thing we got to look at is distribution planning, where you're taking money out of your numerous investments, but also paying the least amount of taxes whenever you're taking those withdrawals out. We also have to look at healthcare costs, extended care costs, estate planning, insurance planning. We have to cover all these things, but actually we have to look at how do they line up with your tax liability.
Yeah, a lot of that. If you're watching at home, that's tax-friendly, tax-free, tax-efficient. I like it all. Question number 7, there are financial professionals, and then there are those that specialize in retirement planning. why are financial professionals not always equipped to help with the next stage of life, which is retirement?
So the big thing is whenever you're withdrawing money from your investments, you know, it's one thing whenever you're accumulating money because you're working, you have a paycheck coming in to cover your expenses. But if you're taking the same amount of risk in your accumulation phase and you start taking that same amount of risk in your distribution phase, taking money out of your portfolios can shorten the lifespan of your portfolio. So having a distribution understanding of the way the portfolio needs to work, needs to behave, is something that's very crucial. But also how taxes come into play, healthcare costs come into play in retirement. That's what sets up a retirement-focused firm than just any investment firm out there.
Knowledge is power. John Blanchard, 7 questions in, still 8 to go. More to come, but first today, exclusively for our Finance Report viewers, John has a great offer. Right now, for the first 5 callers with a portfolio of $250,000 or greater, he's offering a no-charge, no-obligation, full-blown retirement income plan just for you. This will allow John's team to sit down with you personally and provide you with a roadmap going forward. Again, all of this at no cost. The number to call right now, 337-366-8366. Once again, that number, 337-366-8366. Fire that clock back up. Question number 8, saving up for retirement is one thing, but John, withdrawing, that's another. What do people need to do to determine the optimal sequence to withdraw their money?
Look, ideally, we got to look at where they're pulling their money from. What type of taxable account is it? Is it a taxable account, tax deferred or tax free, to supplement their Social Security? The other thing is we got to look at how much risk they're taking whenever we're choosing which bucket, which investment account they're pulling from during their retirement phase.
Question number 9, 401ks became a thing in the 80s, but for some retirees, there can be a quick spin down in those accounts. Why is there such a widespread issue when it comes to dealing with a 401k?
Look, ideally we got to look at inflation, needing more money right now, but also if you're taking too much risk. So on years where we have major drawdowns and you're pulling extra money out of those too, not just excess, but extra money out of those, you're doubling the loss on that account for that time period. So you're shortening the lifespan of that overall account.
Yeah, you don't want that. Question number 10, a recent study focused on Social Security and found that 72% of people are fearful the benefits of it won't be around for them. Should people be feeling this way?
Look, a lot of people should be very nervous. I mean, I'm nervous about it. I'm not expecting to receive benefits myself. But the key thing is we got to look at where can you build your own economy, create your own economy. You can have a plan that in the event where the government falls up short on paying you, you have other assets that are going to pay you for the duration of your life.
Building my own economy, sir. I like the sound of that. Question number 11, we want to have a more secure retirement and enjoy our lives, but in your mind, John Blanchard, what are the keys to accomplish that?
Look, ideally, we have to look at your tax liability, your healthcare liability, understanding your risk, and making sure that we understand what each dollar is being used for. Everything has its own purpose, and we understand how each dollar gets taxed as well.
How often are people, I'm going sidebar again on you right now, are unaware of the purpose of their money?
Most. I mean, look, the thing is, a lot of people just save the nest egg and they're trying to do everything with it. But what we want to do is we want to organize their assets and they're using those assets for specific things. And also they're tying a different amount of risk to each of those assets because of what they're using it for.
Okay, when I give you extra questions, you get extra credit, by the way, so that's good for you right there. Question number 12, no surprise, the wealthy are typically more confident about their retirement outlook. But why do you say, not so fast, my friends? There's plenty to be worried about.
Yeah, legislative risk. This is what they should be worried about. A lot of people that are very wealthy have a huge tax liability. And a lot of people have saved and invested a lot of their money in tax-deferred accounts, which we don't know what the tax code of the future is going to be, but the amount of debt our country is accumulating puts more and more pressure on IRAs and 401ks and SEPs and solo 401ks and such. So we have to look at deconstructing these and moving these to tax-free investment vehicles such as Roth IRAs or Roth alternative accounts.
Yeah, Uncle Sam, waiting there to be our silent partner in retirement. Question number 13, some might believe the way to wealth in success is trusting their gut feeling. How much of a retirement, though, is really based on a good guess that pays off?
Look, there's a lot of people that have good guesses, but we have to look at data. We have to look at information. We have to make calculated decisions to place our dollars in the right place, not just for growth, but for principal preservation, but also on preserving your capital from being overtaxed.
You don't guess putting people's plans together, right?
No, not at all.
Question number 14. A survey found that some people plan to relocate once they retire, but not to be closer to family. No, 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 no. It's much worse than that. It's because of lower living costs. They're fleeing. It doesn't have to be like this to make our money go further, does it?
Yeah, look, there's lower living costs from housing, but we also have to look at taxes. You know, look how many people flee California, Massachusetts, and other states that have a high state tax. You know, Florida's very attractive. Tennessee's very attractive. Texas is very attractive. Louisiana's not bad. But we have to look at overall cost. Where can you cut your cost if you need to, depending on what type of lifestyle you want to have, what climate that you want to live in.
Yeah, Louisiana, not bad. Does that mean you're inviting those fine folks from California here?
If they have great principles and values, they're more than welcome. And look, we have plenty of food for them, for them to have.
Okay, absolutely. Got you going. Question number 15, the final one. People enjoy putting their money in different pots, lots of different strategies, but what about gold? Do you like gold when it comes to a retirement plan?
Look, some people are looking at gold as the one and only investment vehicle that they're going to use. Warren Buffett doesn't put all of his money in gold. Gold just sits there. It doesn't produce a dividend. It doesn't produce interest. Yes, it's helpful in inflation. Gold is up right now, you know, but we have to look at having a plan to where you can take distributions, your money can pay you dividends, you can earn interest. It's not just sitting there. There's a place for it, there's a time for it, but it's not something that you should use for 100% of your portfolio.
Diversification, very important. Also important, we're done with 15 and 15. Excellent information as always. Congrats, you're off the clock. For those looking to make sure they're on the right track for their retirement, John has a great offer right now for the first 5 callers with a portfolio of $250,000 or greater. He's offering a no-charge, no obligation, full-blown retirement income plan just for you. This will allow John's team to sit down with you personally and provide you with a roadmap going forward. Again, all of this at no cost. The number to call right now is 337-366-8366. Once again, that phone number, 337-366-8366.
With longer lifespans come longer retirements. So how can you do a better job of planning for the future while truly living in the present? Let's talk retirement buckets. These red buckets here symbolize today, the near future, and years down the road. John, as we get started, tell me why it's so important to look at retirement this way.
Yeah, look, ideally what we want to do is organize our assets where everything has its purpose. So we're using these funds for different things specifically. And so that's the way to look at it whenever markets get rocky. We understand, wait, I'm fine because these dollars are functioning for a certain reason. Not everything as a whole, I'm trying to make it work to do everything at the same time.
I like that mentality. Let's get started here. No risk, low risk, high risk. In your mind, where should they land on this board?
Yeah, look, so no risk investments, we want to look at the now bucket,
okay.
Money that you're going to be using soon. Now, the reason why you're doing that is because you're going to be placing your emergency funds inside of that particular bucket.
Okay.
You know, your planned expenses. These are things that we are going to be utilizing very soon. This is purchases for vehicles. This is vacations that are coming up. Maybe you're going to remodel your kitchen. So this is money that we're going to have there, but we cannot have any risk associated. So we're using CDs, cash, money market accounts, treasuries. Very, very solid from a principal protection standpoint. These are the type of assets that we're using there.
So a lot to consider. Yeah, low risk and high risk.
Yeah, so I mean, your low risk accounts, we're looking at your soon bucket. This is money that you're going to be utilizing to offset your income whenever you're receiving Social Security or you're going to have a pension. So these assets you're going to be drawing from, and you want this money to grow to outpace inflation, but you don't want to take large drops in the market in the event we have a market downturn.
Sure.
You don't want this account to experience a tremendous amount of volatility. Very low volatility in this particular bucket.
All right, so with that in mind, where does high risk land?
Yeah, well, the high risk itself is in our later bucket. This is money that we're going to be using in the future, in the next 15 to 20, 25 years from now, depending on your current age. But we're also using this money in the future for healthcare expenses. But we're also using money in the soon period too for healthcare.
Okay.
So we're going to leave that here. Now, legacy planning is always going to be a later focus. We're planning for it now, but this is money that's going to be tied up, that's used later on down the road.
So John, legacy planning I think can be very intimidating for people to talk about. What do we need to know?
Yeah, I mean, the key thing is we got to look at number one, where do you want the money to go?
Yeah.
So your money can go to 3 different areas. It could go to your heirs, it can go to a church or a nonprofit, or it can go to the IRS. So if you were going to plan, where do you want your money to go? If you're going to get rid of one of those 3, which one would you reduced from that list?
Sure, sure.
Probably the IRS.
Yeah.
So legacy planning is key because we want to make sure you keep majority of your money while you're alive, but also your family gets to keep majority of it instead of the majority of it going to the IRS.
The key word there being plan. John,
Exactly.
income, something you talk a lot about.
Yeah, so soon, like income planning is something that we have to focus on, and we're going to make sure that's tax efficient. So distribution, tax efficient distribution planning is key. So this is in the soon bucket. We got to look at where you're going to pull your money from, how much risk you're taking. Typically, income accounts are lower risk accounts, but future income that you're going to have, this is money that's going to be, you're taking 15, 20 years down the road, you're going to take a higher risk with these accounts. The other thing we got to look at is long-term care.
Sure.
Nobody is signing up to be inside of a nursing home or having in-home care. But the thing is, 75% of people above the age of 65 will need some form of health care, long-term care in retirement, extended care. So we got to plan this out, and this is something for later. But taxes, this is something that is going to be in all three buckets. We got to look at
you could spend this whole show talking about taxes,
just about
John.
taxes, because that's a big thing. That's a big expense for every American's retirement.
John, how do you start that conversation about long-term care? It's a tough conversation to have.
So we got to look at how people's loved ones have been affected over the last several years. And so if you can privatize your own care in the future, so you're not regulated as much, where you can be at your own home, watching your own TV, sitting on your own couch, being taken care of by, family members, but you have nursing staff, et cetera. But we have to look at where that money's at, but where to find money to earmark to cover these costs in the future.
What should our takeaway be here, big picture?
I would look at, number one, where you're placing your assets, but how will taxes will overshadow everything on your distribution, the growth of the investments, and whenever you transfer these assets in the future.
John, really important information. Thank you for breaking this down for us. And once again, more to come on the Finance Report. But first, for you at home, if you want to make sure your retirement buckets are in order, John has a great offer for you. Right now, for the first 5 callers with a portfolio of $250,000 or more, he's offering a no-charge, no-obligation, full-blown retirement income plan just for you. This will allow John's team to sit down with you personally and provide you with a roadmap going forward. Again, all of this at no cost. The number to call right now, 337-366-8366. Once again, that number, 337-366-8366.
John, I want to revisit something you said earlier in the show. You talked about retirees being able to build their own economy. What exactly does that mean?
Yeah, I mean, ideally to be non-dependent. You're completely independent with your own assets. You have cash flow coming in from multiple sources, and you understand the tax liability that you have. You have a game plan for Social Security. You have a game plan for withdrawing money for paying for projects that you plan on doing around your home, the travel that you want to have, you and your spouse or by yourself. So these are the things that we look at. We want to help people be independent from having to worry about Social Security going away because they have enough money coming in to cover all of their expenses.
And John, with all of that in mind, you actually have something special for our viewers watching at home.
That's right. For those in or near retirement with a savings of $250,000 or more, give us a call. Our team will help put together your very own retirement income plan, and we'll do this on a complimentary basis.
A generous opportunity. Thank you, John. So again, exclusively for our Finance Report audience, John has a great offer right now for the first 5 callers with a portfolio of $250,000 or greater. He's offering a no-charge, no-obligation, full-blown retirement income plan just for you.
This will allow John's team to sit down with you personally and provide you with a roadmap going forward. Again, all of that at no cost. The number to call right now, 337-366-8366. Once again, that number, 337-366-8366.
Thanks for joining us on the Finance Report. We'll see you back here next time.